Welcome back to our lecture for Chapter 7, Plan Assets and Intangibles. We are going to start by explaining what an asset impairment is and the effect it has on the financial statements. So assets, both tangible and intangible, they must be tested for impairment. And this occurs when what is expected as future cash flows is going to be less than the book value. Remember, the book value is our cost minus our accumulated depreciation. So if we expect our asset to have a lesser value than that, then we have to make sure that it is adjusted. And the way we account for this impairment is in two steps. So if our net book value is greater than our cash flow, and if yes, the asset is impaired, then we must go down to step 2, which is we take our net book value minus our fair value, and that is our impairment loss. So basically, if we have a net book value of 100 million and our estimated cash flow is only 80 and our fair value is 70, here we know that our net book value is greater than that, so we know we need to move on to our next piece, which is our net book value of 100 million. We subtract the 70, so our loss that we're going to book is 30 million. And our entry to do that is impairment loss for 30 million, and then whatever the long-term asset was that we are impairing. So pretty easy entry there. Now we're going to move on to our ratios. And so this ratio, the return on assets, ROA is sometimes called, equals your net income. And so our ROA equals our net income divided by our average total assets. And remember, to get the average, we have beginning balance plus ending balance, and then we divide it by 2. And don't forget, you can also use the average formula in Excel as well. So make sure this is in your Excel template. Now we are looking at a more detailed view of our return on assets. So basically we have our net profit margin ratio, which is our net income divided by net sales. And remember, we said that gross sales, you should have this in your Excel, less returns and allowances, sales returns and allowances, less sales discounts equals our net sales. So make sure you can calculate and get to net sales. So you should have this in your Excel. Net profit margin ratio equals your net income divided by your net sales. Then your total asset turnover ratio is your net sales that is divided by your average total assets. And so you see our two formulas here, our net profit ratio and our total asset ratio. When you take the two, then you get your return on assets. So now, lastly, what we are going to cover is the cash flow effects of basically long-lived assets. So depreciation, if we are using, so this is on the statement of cash flows, and you'll see our statement of cash flows has 3 types of activity: operating, investing, and financing activities. And our depreciation is in the operating section, and it's added to net income as a reconciling item because remember, depreciation is non-cash. So we're talking about our statement of cash flow here. If we sell a long-lived asset, that goes in investing, but the proceeds from the sale, and then if we purchase an asset, is also in investing as a cash purchase. So this is the end of our video lectures for Chapter 7.